Good morning. Welcome to everybody. Okay. First of all, the presenters. My name is Andy Kelleher. I'm a founding member of Kelleher Holland, Attorneys at Law. I'm also, my background is I'm an attorney and advanced law degree in tax and also CP representing wealthy family and business owners. Ed, you maybe want to, I'll talk a little bit about Ed here. Ed Morrow, we're really excited to have Ed on today's presentation. Ed is a nationally known, a very prominent author and lecturer on estate planning. And we'll be talking today about a new income tax provisions that will be added to a lot, if not all trusts going forward, or most trusts. And Ed basically has been writing a lot about this for many years as a true thought leader. Ed is, part of, as it says on the screen, he's a board certified specialist in estate planning and trust law, and he's also a fellow at ACTEC. So we're really proud and excited to have Ed on today's seminar. And also just for some housekeeping, Ed is a independent lawyer and independent speaker, and he is not officially part of Kelleher Holland. So just for purposes of some tidiness there. A little bit about Kelleher Holland. Kelleher Holland is known as a one-stop for legal services. We pride ourselves on providing a 360 wide and deep platform of legal services. So we're a full service law firm. We're headquartered in North Barrington with offices in Hinsdale and Waukegan, also Naples, Florida. And we're licensed in many states throughout the country. We are also very proud to be part of Macro International, which gives us a international addition to our platform with the other terms of similar sizes where we can efficiently help many business owners and clients that can't afford or otherwise don't want to go to some larger law firms. So we do provide some comprehensive capabilities, and we really work hard to tailor solutions for our clients. So if you take a look at the wheel, it gives you a pretty good idea of what Kelleher and Holland can provide. Estate planning services, to make it quick, we have the team. The estate planning team is, the pictured below. Kelleher Holland is about 60 teammates. We have about 32 attorneys. And we have many other groups, but for estate planning services, we provide, like I said, a wide and deep platform of estate planning services. And we have one of the larger and most talented teams that I'm aware of in this area of the law. All right, what we're talking about today, we're talking about the new income tax provision that we're adding to almost all of our revocable trusts and irrevocable trusts. To do a couple different things. It's called the Beneficiary Income Accumulation Trust. And what it is, it's multi-generational income tax savings. It also is a way to provide clients with additional income tax deductions, ease the tax administration, also enhance the multi-generational estate and generational skipping tax and other transfer taxes, and also streamlined tax return preparation and enhance, long-term creditor protection for our clients. So we're really excited about the Beneficiary Income Accumulation Trust idea and the practical use of this item because it really is something newer and something that is really solid and something that I think in the next 3 to 4 years will become commonplace. And I think after, everybody on this webinar sees the power of it, I think it'll become something where people really should start shifting towards BIAT planning or seriously considering it, because not doing so could cause problems for the practitioners who are not aware of this. All right, let's talk a little bit about what we call the old-fashioned trust income tax planning concept. Is Internal Revenue Code subparts A through D of subchapter J. And it's pretty much the regime that we've all been taught, okay, and all have been using for many, many years. It's commonplace, but we want to talk a little bit about why the old-fashioned trust income tax planning may not be the proper pathway for many of our clients. So let's just start with a little bit of an example. We're trying to make these slides a little bit more fun than normal. We have the Weber family, right? This is a traditional family where we have Fred and Susie, and they have both of their sons, Todd and Tyler. I want to make sure that we're using the example of a traditional family, but the BIAT provisions and what we're talking about applies to single people, non-traditional families, second marriages, and pretty much all folks. But just for example, we're using Fred and Susie. Now, for today's conversation, I want to narrow down what we're talking about, okay? So what we're talking about in the Weber family situation, unfortunately, we're talking about what happens after Fred passes away. And we're going to be focusing on income taxation of the trusts, okay? So we're assuming, which is that most of the people on this call understand, or at least are somewhat familiar with basic trust planning. So for example, most of the time when we have a client such as Fred and he passes away, he has a revocable living trust. And after Fred passes away, there's two testamentary trusts or springing trusts that would come into existence, okay? Many times called the AB trust or a family marital trust structure, very typical. But then we have a family trust that would credit, would preserve Fred's estate tax exemption, and we have the marital trust would make sure that upon Fred's passing, upon the first spouse's passing, that we don't have any taxes due at that time, and we would use the unlimited marital deduction. Okay, so we're not talking today about any estate tax planning, okay, because the assumption of today's talk is that when Fred passes away, we're going to be focusing on that family, that credit shelter trust, where Susie is the primary beneficiary of that trust. And for all purposes of today, Susie and the trust are separate taxpayers for estate and gift tax purposes, which means that Susie and the family are getting all the benefits of estate tax, generational skipping tax, and other transfer tax planning. We're focusing on income taxes today. Let's talk a little bit about that. So under the old-fashioned method, under subparts A through D of subchapter J of the Internal Revenue Code, we have it normally, what we normally see throughout, customarily is that Susie, okay, and the family credit shelter trust are separate income taxpayers. So when Fred passes away under his revocable trust in our example, there's the family credit shelter trust that's set up. Okay, and that trust would be funded upon Fred's death in this example with $4 million of family assets. Okay, and let's assume in our example that there's 5% income per year, which would be $200,000. In the old-fashioned method, okay, the trust would be filing a Form 1040, and this is where they had to be subject to a compressed tax bracket Fred's trust, okay, would be paying the highest marginal income tax rate of 37% at only $13,451. And that is anything above that is taxed at 37%. And also there's an additional 3.8 net investment income tax that the trust would also be subject to. So if Fred passes away, and the $4 million, it produces $200,000 of income, and that income stays in that trust, that income is going to be hit very, very hard by the income tax rates because of the compressed tax bracket and the net investment income tax. So what do we do customarily to try to alleviate that income tax consequence in paying higher income taxes by allowing the income to physically stay inside that trust? So same situation, the trust and Susie are separate income taxpayers. So what we do is when the family credit shelter trusts with the $4 million, it produces the $200,000 of income. What we do is we try to get out of the compressed tax rates of keeping the assets in the trust, and we make a D&I distribution of income out of the trust to Amy personally, okay, where Amy would file that $200,000 on her personal income tax return, and she would also benefit from that on an income tax basis because the brackets, she wouldn't be paying the highest 37% for income tax purposes until she reaches about $539,000 in change of income. And also she would also have a better net solution or result, because she wouldn't hit the NIT until she has $250,000 of income or so if she's a qualifying widow in 2002. So I also want to focus on in the middle of this example or the picture. You see that the arrow, when the $200,000 comes out of the trust to Susie, it's counterproductive. Okay, and what we'll get into later is that when we're forced, okay, to distribute the income, physically distribute the cash out of the trust to avoid the high tax rates, to get a better income tax result to Susie, when we take the cash out of the trust, that's counterproductive, okay, for estate and transfer tax purposes, because the assets are no longer allowed to stay in trust to get all the benefits provided by the trusts for estate and transfer tax purposes, and also for creditor purposes. So I want to make sure that we understand that DNI is counterproductive, really counterproductive, and we'll see in the math later in the webinar. We'll see the results of that. All right, so I made this point already, but many people think that the way that everybody's always done it, the old-fashioned method, is okay, but it really doesn't have the horsepower of the BIAT provisions, the Beneficiary Income Accumulation Trust provisions we'll talk about, because the old-fashioned method is not optimal for income tax planning, estate tax planning, and transfer tax planning, as well as creditor protection. It's old-fashioned. Let's talk a little bit about BIAT planning, okay? Beneficiary Income Trust, Accumulation Trust planning is something that should be considered, and I think that will become commonplace going forward as more people understand what it is, but it's maybe a more modern way of looking at income tax planning and trusts. So let's talk a little bit about that. So with BIAT planning, okay, unlike old-fashioned planning, okay, the trust and Susie are the same income taxpayer, okay? Because what we're doing is we're shifting the strategy from subparts A through D of subchapter J of the Internal Revenue Code to a new subpart called subpart E of subchapter J of the Internal Revenue Code. And we'll talk a little, and Ed will get a little bit into that, but the idea is that because the trust and Susie are the same taxpayers, okay, Susie isn't forced, or the tax planners aren't forced to advise Susie to physically distribute the income out of the trust to Susie every year. Susie has choices, okay? So before we get into that, that concept of allowing more value to stay in trust and giving Susie more choices over her income tax management, Ed, why don't you talk a little bit of how subpart E and how the annual withdrawal right of all the taxable income comes into play to make Susie the deemed owner of the trust.
Yeah, and I think that was a great summary of how normal non-grantor trust taxation works. Subpart E is what we call a lot of people refer to as the grantor trust rules. That's section 671 to 679 of the Internal Revenue Code, and that's the statutes that basically say under these circumstances either the grantor is deemed to be the taxpayer, like a revocable living trust or an IDGIT or a SLAT or GRAT, or there's one particular code section 678 that says, if the grantor is dead, there's still one provision that says when the beneficiary is deemed to be the owner for income tax purposes under 678, and that's if you have the withdrawal right over all the taxable income. It can't be, exercisable with, consent of the trustee or exercisable with another party. It has to be, in this particular case, Susie, has to have an unfettered annual withdrawal right over the taxable income. But if she has that, she's deemed to be the owner under section 678 of the code. And that means she gets to use her tax brackets and all the beneficial, provisions and, that individual taxpayers get. So you're kind of getting the best of all worlds. You don't have to take it all out. You can leave it in the some of it in the trust or all of it in the trust to get all those asset protection, divorce protection, creditor protection benefits, sheltering from Illinois state tax, federal estate tax, all those benefits without having, but yet you still get to use the individual tax brackets, which are 99% of the time going to be much better off and save the family a lot of money.
Exactly. So we'll move on to the next slide here. So let's talk a little bit more about what Ed was just talking about. With the BIAT planning, Susie has choices, right? So when we have that family trust, that credit shelter trust, let's say it makes the $200,000, which we talked about on the screen, the previous screen, is that Susie and the trust are both the same income taxpayer, and all of the income from the trust and all of the income that Susie would have on her own personal balance sheet would be reported on Susie's, personal Form 1040. So here's the idea though. For the $200,000 that the trust makes, okay, let's just assume that, Susie has a 30% income tax rate individually on her 1040. Well, the $200,000 that the trust produces in income was going to be taxed at the 30%. So we have $60,000 of income tax that would be due, that's associated with the $200,000 of of income that came from the trust. So the first thing is that Susie has enough of her own assets, her own cash to pay the $60,000 with non-trust assets. That is the optimal answer for Susie for tax planning purposes, for both income tax planning purposes and for estate and gift tax purposes. So what the idea would be, Susie can pay with her own assets off of her on her personal balance sheet of assets that are not in the trust. She can pay the $60,000 to the government. And the key is that the whole $200,000 of income inside that family trust is allowed to be added to principal and roll forward, going forward. And if that happens every year, where Susie pays the income taxes with her own non-trust assets and allows that $200,000 to keep on being added to principal every year, you can see over a 10, 15, 20-year period, there's going to be a lot of value that's going to be in trust. That's going to provide the family way better estate and gift tax planning results and way better creditor protection results. And the idea is not have any income tax detriments. And so we'll talk about later, there's actually going to be a lot of income tax benefits when you compare the BIAT planning income tax deductions compared to the old-fashioned method. On the alternative, let's just say Susie doesn't have all the money on her personal balance sheet to the $60,000 to pay the income taxes. Well, instead of having the entire $200,000 of trust income be added to principal of every year and allowed to stay in trust, maybe Susie can take a portion of all of the $60,000 out of the $200,000 of income, but then she still has the $140,000 of after tax income staying in that trust. So no matter how you cook it, Susie's going to be better off with the BIAT planning when it comes to the income tax management. Okay, let's talk about it. So we'll just rehash a little bit, is that the old-fashioned method and the BIAT method, because it's all the because all the income is going to eventually be reported on Susie's personal income tax return on both methods, they have similar tax brackets. However, right, as I said earlier, the BIAT planning is going to provide additional income tax deductions, which we'll get into. So the BIAT planning is better for income tax planning because of the additional and available income tax deductions, even though the tax brackets may stay the same under both methods. And the BIAT planning is much better for estate and transfer tax planning by allowing Susie the choice of keeping assets in trust, as I explained earlier, and the long-term creditor protection that's allowed to protect Susie is excellent and better because the BIAT planning allows more assets to stay in trust in that protected zone. Okay, Ed, I'm going to turn this slide over to you. Maybe you can talk a little bit about the income tax deduction benefits of BIAT planning, as well as some other, tax goodies, income tax goodies that BIATs provide that the old-fashioned method just doesn't provide.
Yeah, there's quite a few advantages for for grantor trusts over non-grantor trust in general. For instance, in your example, let's say Susie had some capital losses in her own name, and the trust had some capital gains, for instance. Because they're considered together, she can deduct her capital losses against the capital gains that are inside the trust, because it's all considered, as one taxpayer. You wouldn't have that if it was a non-grantor trust and the capital gains got trapped inside of the trust. You wouldn't be able to offset personal capital losses against the trust's capital gains. This type of trust under 678 of the code, because it's considered a grantor trust, can hold S corporation stock without a quist or an SBIT election, which can be kind of sticky and hard to qualify for sometimes, and people trip up because they don't file the proper forms, and then they have to go to get a private letter rolling to get the S corporation back on track and things like that. This is going to automatically apply, qualify as an S corporation owner under the grantor trust rules. Anything under subpart E is going to be a qualifying S corporation owner. And also, this is kind of a little known detriment and problem with non-grantor trust, Andy, in that, anytime you've got a business owner that leaves assets to their spouse and kids in trust, a lot of business owners, the one code section that they know and love is this 179 expensing deduction, where you can deduct over $1 million, up front in year one under 179 for certain kinds of, let's say you buy the backhoe or a bunch of new computer equipment, whatever, you can deduct in year one instead of over 5 years, 10 years, 15 years, whatever the life of the particular asset is that you're trying to depreciate. 179 can be a very valuable deduction, but under 179 D4, non-grantor trust in the states do not receive that deduction. And so, a non-grantor trust, if you leave assets to wife and kids in a normal non-grantor trust, and there's business 179 deductions passing through, no, the trust is not going to be able to take advantage of those. And so you may get a situation where you've got, two brothers that own the building, and one dies and leaves 50% of the business to the widow, and you've got the one brother is getting this juicy 179 deduction, and the widow is not getting any because it's passing through a non-grantor trust. But if it's a grantor trust, remember, you can still get that because it uses the same tax rules as an individual. Very similar is that housing deduction. A lot of us, in the Midwest, where we don't have these multi-million dollars of appreciation, you sell your home, $500,000 is, a capital gains tax exclusion. So not a lot of people pay huge capital gains on their sale of their home because of this 121, section 121 of the code allows this huge 500,000 or 250 if you're single, a capital gains tax exclusion. But a non-grantor trust doesn't get that advantage. And this is problematic when you've got people that want to use the Illinois or state tax exemption. So they want to leave the home to the survivor in trust, because they want to soak up the applicable exclusion amount. Well, if you leave the home into a normal non-grantor trust, you're not and then the surviving widow or death, sells the house. Yeah, you're not going to get it in a non-grantor trust. You're not going to get that juicy capital gains tax exclusion. But if you had the power in the beneficiary under 16678 of the code that we just talked about, this BIAT planning that as you call it, that would get the section 121 housing, capital gains tax exclusion. As long as it's still a residence of the beneficiary, they can still get this $250,000, or if they remarry, $500,000 of capital gains tax exclusion. There's also some special deductions for real estate losses that non-grantor trusts don't get to take, but individuals do get to take. Sometimes there's an advantage for business owners under the 199A deduction, because of the way trusts are kind of have certain limitations, particularly if it's a service business. Individuals can oftentimes get much better, tax deductions than non-grantor trust can, particularly for those service type businesses. Remember that SBITs that are non-grantor trusts don't get a distribution deduction, so you can easily, have the income that exceeds, these limits where you're kind of capped on your 199A deduction, particularly for service businesses, and that can be a really beneficial deduction. As we know, 20% of the qualified business income is a pretty juicy deduction. there's also a lot of limitations when you have a normal non-grantor trust. Susie, in our example, Andy, let's say she wants to take some of that $200,000 and give it to her local her charity, and it goes from the trust. Unless the trust has very specific provisions in it, you're probably not going to get a trust charitable deduction. And even if there were provisions in there, there's all kinds of limitations. They have to have, like, be able to trace it to gross income, and all kinds of different provisions under 642C, where you can not really get the same deduction that individuals can. Individuals can carry forward multiple years, 5 years, right? If you can't use a deduction this year, you get to carry forward to next year. Trusts don't get that deduction, right? So there's some advantages to having, Susie be considered the taxpayer even for charitable deductions. And of course, the mortgage interest deductions, if you did have the home paid to the, trust that's continuing to pay mortgage interest, that can be beneficial as well. So, these are just a few advantages of having it continue as a grantor trust even after the settlor has died. The grantor has died, Fred, in our particular example, so, it's not just the tax bracket advantage, even though that is huge, right? I mean, most middle-class taxpayers, unless you make 600 grand plus, you're not in the top tax bracket. So, Susie, in our example, if she's in a 24% bracket, making a couple $100,000 or something like that, the difference, that delta between the, 37 plus 3.8%, and the 24%, that can be huge over time, an additional 13%. Also, that number, Andy, might get worse in a few years. Remember, the Tax Cut and Jobs Act, it goes from 37 to back to 39.6% in a few years. So, this advantage might actually be exacerbated in a few years.
So the bottom line is that by having Susie and the trust as the same taxpayers, and having all of the income and all of the deductions, right, being reported on Susie's personal income tax return, is going to produce, in most, if not, I say almost all cases, a better income tax result for people who own businesses and people who have investment accounts, and it'll just make their life a lot easier. And that's what we're trying to do, right? We're trying to relieve anxiety for clients and provide them with better solutions and make their life better, right? So I think the BIAT goes a long way to do that. So here we go. So let's talk a little bit about authority, Ed. The idea is a lot of people are saying in their heads, yeah, this is a newer concept. It really isn't. It's been out there forever. It's just something that we haven't been, as practitioners, using. Can maybe talk a little bit about the authority behind BIATs, otherwise known as beneficiary deemed owned trust planning. Go a little bit through, you've written extensively about this. I want everybody to know on this webinar that Ed has very beautifully drafted white papers and articles and seminars for many years on BIATs, and we really do have an expert here. So talk a little bit about the authority, Ed, behind BIAT planning, and maybe explain that once Susie has the right to withdraw all the income, she's the taxpayer. How, talk about the law.
Yeah. And believe it or not, this has been long in the tax code. Even before this section 678 was even added to the tax code in 54, we had the Eighth Circuit case of Mallinckrodt, or if I'm pronouncing that name right, v. Noonan, and even cases before that basically go to the principle that if a taxpayer can control the income of a trust, they should be taxed on it. The Supreme Court said that in the Harrison case, and then the most famous case that was later cited by Congress is this Mallinckrodt case, which they cited when they put Section 678 in the code, basically saying, look, it's different. If you have a revocable living trust, we're going to tax the person that can revoke it, right, or idiots and grants. But let's just take cases where the settlor has died. When should a beneficiary be taxed on income if they can control it, if they can access it, right? Or withdraw it? Is, the 678 actually uses the term best. Best just means ability to withdraw the income. But by income, they don't just mean income that, like rents, dividends, interest. That they mean any taxable income, which could include capital gains. And so the Campbell case is kind of famous for the proposition that what happened in the Campbell case was the taxpayers, they could have withdrawn the capital gains, but they didn't. And they said, oh, this should be paid, the tax should be paid by the trust. We shouldn't have to pay the tax on it. Tax court said, no, you could withdraw the capital gains, so you should bear the brunt of the tax on it. Now, decades ago, that used to be a very good thing. Congress used to try to get people to, trust to be the taxpayer and such. But right now, and people used to want to set up multiple trusts to spread out income to trust. But with the compressed tax brackets, it's 99% of the time going to be much more advantageous to have it actually be taxed to the individual taxpayer. There was this recent private letter ruling where the IRS acquiesced, and they ruled in favor of the taxpayer who was asking to rule on a particular case where one trust gave a power of withdrawal over to another trust. Why were they doing that? Well, they wanted to leave the assets in trust number 2, but still be taxed to trust number 1. And the IRS said, well, we don't have any problem with that. 678 of the code's pretty clear. If one party, whether it's a trust or an individual, has the power to withdraw the income from a trust, they should be taxed on it. And so, we've got pretty strong authority, even though there might be some on the margins, some, unanswered questions in a few areas. For the most part, there's very strong authority that if you have the power to withdraw the income, you have to pay the tax on it, and the trust cannot pay the tax on it for you. Basically, well, you can withdraw assets from the trust, but the trust is not the taxpayer, which is 99% of the time, Andy, a good thing.
Right. So, big picture, over time, with BIAT planning, allowing Susie and the trust to be the same taxpayer and giving Susie the ability to allow more assets to stay in trust, we're going to have tremendous opportunity for additional estate, GST, and transfer tax savings. So by being smart and taking a really good look at the income tax structuring of a trust and getting better income tax results, there's by doing the good income tax planning, it also lends towards excellent and better estate tax planning. And it's so powerful, like I said at the beginning of the seminar, for people who aren't strongly considering this for their clients or learning more about BIAT planning. I think that would be a concern for me. People really need to know this, because this is something that can really help out people and make people's life easier and provide better results for our clients. But it just doesn't, the next concept is the planning benefits don't end with Susie. In our example of this family, the Weber family, Fred passes away. We already explained why Susie's in a better position with the family trust, where she gets all the estate tax protections, and by adding beneficiary income accumulation or BIAT trust provisions, she's going to be in a better income tax position. But when Susie passes away over the course of time, many decades, the Todd and Taylor are more, in most plans, are going to have trusts that are established for them, and they're also going to benefit from this multi-generational combination of better income tax planning with the BIAT, and also get the benefits of enhanced estate and gift tax results for Todd and Tyler over the course of years. And of course, we'll have more assets in trust. And these days, people are getting divorced a lot and have other creditor problems. Todd and Tyler would be in a much better position for creditor protections. In many cases, unfortunately, it's divorce. So, Ed, let's talk a little bit about the math. So the idea is just to kind of give the folks on the webinar a little bit of an idea of the additional amounts that can be allowed to stay in trust. Maybe you can address the screen.
Yeah, and the difference is you're always going to have more value in the trust, by virtue of having a lower tax rate, right? Now, we're kind of assuming that the income tax is paid by, trust assets, and that the grantor is going to withdraw at least, or not the grantor, the beneficiary is going to withdraw at least enough to pay the taxes. But even still here, the value of the trust is going to be increasing by the delta, the difference between the tax rate on the income that the trust pays and the tax rate that a beneficiary pays. And the key thing is, you can always have more assets stay in trust with traditional non-grantor trust planning, but you're paying a big price by having everything above that compressed tax rate, above $13,451, be taxed at the very highest rate. So you're paying additional income tax by, to get that benefit of additional estate tax sheltering and additional, creditor protection of leaving money into trust. So what we've done here is, and your team did the spreadsheets on this, which I thought were pretty well done, Andy, but you've got extrapolating 10 years hence, 20 years hence at about, at 7% growth rate. And, this original $4 million, it's going to, close to double in 10 years, close to that, in a BIAT, because your taxes are being paid with outside assets rather than with trust assets. And it's going to, double again, of course, in 20 years, because you're basically growing it at a higher rate because the taxes are being paid out with outside assets, or at least they're going to be taxed at a lower rate as well. So, we could probably tweak, different numbers, assume a different growth rate or different tax rates, because of course tax rates might go up in a few years. But either way you shake it out, Andy, over time, that difference between getting the lower tax rate and being able to grow essentially tax-free because the beneficiary is paying the tax rate, enables you to keep much more inside of this trust. And the benefit is not just saving the income tax, is if you're in a state with a separate estate tax like Illinois, the fact that the beneficiary has less in their name and the trust has more in their name means you're sheltering more from state estate tax, even if you were under the federal estate tax threshold. So there's state and estate, federal estate tax benefits. And of course, the asset protection, when you get more money inside of the trust, than outside of the trust, it just means there was more protected from, remarriage, divorce situations and things like that, as well as estate tax issues. So, we can kind of go through the numbers here. Obviously, the longer you consider it, the more the savings is going to be. If you go out 20 years instead of 10, and the savings is going to double, as you see from here. But, it's going to be kind of a linear projection, right? You're going to have it go out, and the longer the number of years, the more the savings is going to be. Obviously, there's not going to be big savings if you assume zero growth. Right. Because then the tax situation, there is no tax and if you don't make any money. But as long as you assume a positive growth rate over time, the fact that we can get it at the lower individual tax rate and have the beneficiary pay that tax bill for the trust just leads to more and more savings every year.
Right. And also, although we didn't put it as part of the example, because it would get way too complicated for purposes of a webinar. But the idea is that there's additional deductions that would be potentially available with the BIAT planning, like we illuminated earlier in the discussion, that would be available, which we really haven't, factor that in. So the tax savings, for the most part, better income tax brackets, same income tax brackets, but enhanced deductions, BIAT planning in many scenarios is superior. So there's something that should be considered, and people need to learn about this.
And Andy, I'll just add too, that particular illustration assumes kind of a middle-class family that might be in a 32% bracket. But even if you had a wealthier family, right? Let's say the widow's also a high-powered executive making 500,000, 600,000 of her own, right? Or in our particular example, Susie's making big bucks on her own. She's in the top tax bracket already. In that case, the savings is not going to be with getting the lower tax bracket, but by her being able to pay some of the tax bill from the trust can grow tax-free. So the savings may not necessarily, be in the income tax ongoing, but being able to shift more value to the GST exempt trust that's exempt from state and federal estate tax and less into her name, you still have, even for a wealthy family, even if you don't have the immediate income tax benefit of a middle-class person, you still get the creditor protection, the estate tax sheltering, the state estate tax sheltering, the protection from divorce and creditors and all that. So there's still advantages even for our wealthier clients.
And also, I think a lot of people, a lot of clients would appreciate the fact that the actual income tax returns that are prepared every year, maybe that would be greatly eased with BIAT planning, where the idea is the form 1041. There's going to be a choice of whether or not just not to file them, just to file the 1040, or if there is a 1041 to be filed, it'll just be an informational type return. But the idea is, I think a lot of clients are going to appreciate that the actual administration and the hoops they need to go through every year should be a lot cleaner and easier for them with the BIAT planning. So even we'll give them the like you said, the better income tax result in paying less tax, but they also should have a lot less income tax issues to deal with, because the BIAT planning, like I said, less tax returns, and also it just eases so many issues that we have to contend with the old-fashioned method, and like you said earlier, the capital gains, offsetting losses, getting that personal level 179 expense, and the other, the 121 house. We just have a lot less complication and a lot less issues with the BIAT planning. So let's talk a little bit about the applicability of BIAT planning. So we just want to make sure that people are aware that BIAT planning isn't one of those, which makes it exciting, is it's not one of those planning ideas that has limited applicability to special circumstances, right? It really is, it should be considered and is applicable to most every revocable and irrevocable trust that's out there, both existing and new. It applies to traditional families, second marriages, single people, blended families. It applies to a lot of situations. It applies to people in the middle class, and it can really help out people who are wealthy. There are some circumstances where it may not make sense, where you have a special needs planning situation, or with charitable trust, or it may not make sense if the beneficiary is a spendthrift and is terrible with money. We don't want to give him or her a full withdrawal right over the income. There are circumstances where you may not want to use it, but most of the time it's something that should be considered and is likely applicable and will give the client a better result. And again, the folks that decide not to learn about this and look at this, I think are, that they really should, because I think they're to do the right things for clients, and and clients will be asking questions of why people aren't doing this later. I think it's something people need to learn and start implementing the BIAT planning. So Ed, let's talk about one thing that I think is fun, is that it's BIAT planning being used with IRA planning and retirement accounts. There's a lot of situations, Ed, where we run into where we have clients that have large IRA balances, and they want to leave those assets in trust for their kids, right? To get, maybe it's a larger part of their estate. They want to get the estate tax use of the estate tax exemptions, or they want to give their kids an enhanced creditor protection, because inherited IRAs in Illinois and most states are not creditor protected. So they want their kids to get the estate tax benefits and the creditor protection. Why don't you speak a little bit towards why BIAT planning combined with what's commonly known as a retirement benefit trust may make sense for a lot of clients?